Welcome to the Coin Bureau Weekly News Roundup. My name is Guy.
And my name is Jessica. Here are the top stories in crypto this week.
The God Candle. BTC experiences an epic breakout, leading many to believe that the bear market is over and the bull market is about to begin. When will we know for sure?
Catch-up trade. All eyes turn to ETH as investors wait to see if Ethereum will copy Bitcoin's recent rally. Here's a catalyst that could make it happen.
Stab in the back. Pro-crypto politicians send a letter to US authorities asking them to investigate two of the largest crypto companies due to illicit activity FUD. What are they doing?
Big banker exits. JP Morgan CEO Jamie Dimon prepares to sell shares in the megabank for the first time since becoming CEO in 2006. What does it mean for crypto?
And a closer look at last week's top-performing cryptos and where they could be headed next.
All this and more in just a moment.
Last week, Bitcoin experienced a phenomenon that's been the focus of some of the most famous crypto memes, the God Candle. This is basically when BTC's price pumps so much that it just doesn't make any sense, wiping out what's left of the bears and signaling the start of another crypto bull run. This is exactly what happened early last week. BTC pumped by more than 10% in 24 hours. The pump was so epic that some of the most high-profile crypto bears have since flipped from bearish to neutral. Some have taken this as a contrarian indicator, but it ultimately depends on why the pump occurred. As you may have heard, the pump appears to have been because BlackRock's spot Bitcoin ETF appeared on the DTCC website with the ticker IBTC. In plain English, DTCC, a company that facilitates trades on the Nasdaq, had added BlackRock's spot Bitcoin ETF to its website. Naturally, this led to widespread speculation that a spot Bitcoin ETF was about to list on the Nasdaq. As many ETF watchers have pointed out, however, DTCC adding a ticker to its website is standard procedure for ETF applications. And as it turned out, the ticker had been added to the website back in August. Even so, this was enough to pump BTC to the point that it squeezed hundreds of millions of dollars worth of shorts. This caused BTC to pump even more. That was, of course, until the DTCC suddenly removed the IBTC ticker from its website, causing a sudden correction for BTC. Just a few hours later, however, the ticker was relisted, causing BTC to correct most of the correction. It's not entirely clear why the ticker temporarily disappeared. On that note, in the midst of all this ticker madness, ETF watchers pointed out that BlackRock's recent spot Bitcoin ETF amendment included a note that the asset manager may begin seeding the ETF by the end of October. As you might have guessed, that means that BlackRock will start buying BTC. The caveat is that this amount is unlikely to be large and is likewise standard procedure for most ETF applications. This was pointed out by Bloomberg ETF analyst Eric Balchunas, who has been the primary source for everything just covered. What's interesting is that he seems to have left something out, though. As reported by Crypto Potato, BlackRock's recent Bitcoin ETF amendment also included the following, quote, "Due to the unregulated nature and lack of transparency surrounding the operations of digital asset exchanges, as well as the wider Bitcoin market, the value of Bitcoin and, consequently, the value of the shares may be adversely affected, causing losses to shareholders." Now, this could likewise be standard procedure, but it's also a reminder that there is intense regulatory scrutiny of the crypto industry in the US and elsewhere. As we'll explain later, this regulatory scrutiny seems to be getting worse, not better. The spot Bitcoin ETF seems to be the only truly bullish catalyst. Now, there's no denying that BTC's recent price action has been impressive, but it's important to remember that there are still risks out there. It's also important to remember the lessons that many of us learned during the last bull market. When you're feeling the FOMO, that's when it's time to pause and think. Consider that crypto's Fear and Greed Index is the highest it's been since the BTC top in November 2021. All that being said, though, there's no denying that BTC is looking insanely bullish. The fact that BTC is about to close the month above the weekly Bollinger Bands is a strong signal that the crypto bear market is almost over. Even so, it's not going to be up only. We're going to see lots of corrections along the way. Now, if you're planning on trading or accumulating as we go along, make sure you're not getting wrecked by fees and that you're keeping your crypto in a safe place. The Coin Bureau deals page has the best of both worlds, the biggest discounts on trading fees of almost 60% and up to $40,000 of bonuses on the best crypto exchanges, as well as the biggest discounts on the most secure hardware wallets. It's a time-limited offer exclusively for the viewers of this channel, so be sure to check it out below. Now, although BTC has arguably entered its next bull market, the same can't be said for ETH or most altcoins. Similarly to stocks, it will only be a true crypto bull market once there is broad participation. Historically speaking, BTC gains eventually find their way into ETH and then into other altcoins. This is why everyone is watching ETH's price so closely. If we are at the beginning of a true crypto bull market, then we should see ETH perform what many traders refer to as the catch-up trade. This is where ETH experiences the same pump BTC did as investors rotate out of BTC and into ETH. There were a few periods last week when it appeared that ETH was about to explode. To put things into perspective, ETH catching up to BTC would translate to a pump of 20% or more. So far, however, ETH hasn't really budged. Not only that, but ETH's price appears to have been rejected by both the weekly and the monthly moving average on the Bollinger Bands. This is a bad sign that foreshadows more losses in the medium term. ETH's price in BTC terms also suggests this. It looks like it's about to fall to its 2020 lows. So, this begs the question of what catalyst could cause ETH to reverse its bearish trend, both in fiat terms and BTC terms. The most obvious answer seems to be one that nobody has been talking about, and that's a ticker for an Ethereum spot ETF appearing on the DTCC's website, or that of a similar company. Everyone seems to have forgotten that ARK Invest and 21 Shares filed for a spot Ethereum ETF back in September. Assuming that listing tickers on the websites of clearinghouses and seeding ETFs are standard procedure, then we could see the same series of headlines around Ethereum and ETH. As with Bitcoin and BTC, this would lead to an unbelievable amount of FOMO that would cause the 20% pump just mentioned. It would also set the stage for a rotation from ETH into altcoins, something that would confirm the beginning of a new, true crypto bull market. The only caveat in this case is all that regulatory scrutiny just mentioned a few moments ago, specifically from the SEC. It looks like SEC Chairman Gary Gensler still believes that most cryptos are securities, despite the SEC's embarrassing losses in court, namely against Ripple & Co. Link in the description if you're wondering what happened there. Now, to be fair, the SEC's recent approval of an Ethereum futures ETF could in fact be evidence that it's open to considering a spot Ethereum ETF application. If this was the case, however, then ETH's price would presumably look a lot different than it does today. It would probably be keeping up with BTC. The fact that it hasn't could be a sign that the regulatory scrutiny around altcoins continues to be very real. It doesn't help that the recent Ethereum futures ETF listing was a flop. It saw a fraction of the trading volume that the Bitcoin futures ETF did in 2021, even with multiple Ethereum futures ETFs being listed. A spot Bitcoin ETF being listed with a similarly lackluster outcome would be a nightmare scenario, to say the least, but thankfully it looks like big investors are taking BTC very seriously. Remember that BlackRock CEO Larry Fink recently said that the BTC pump was evidence of a flight to safety. By the way, if you're enjoying the video so far, be sure to smash that like button to give it a boost. Now, while everyone in crypto has been distracted by the spot Bitcoin ETF hype and the hopium around a potential rotation into ETH, pro-crypto politicians in the US did something last Thursday that can only be described as stabbing the crypto industry in the back. Senators Cynthia Lummis and French Hill sent a letter to the US Department of Justice, or DOJ, asking them to investigate Binance and Tether for their potential involvement in illicit financial activity involving crypto. Not surprisingly, the letter cited recent mainstream media FUD about this factor. What's crazy is that the letter acknowledged that this mainstream FUD was in fact that crypto isn't used that widely in illicit financial activity. In reality, illicit financial activity continues to be done almost exclusively using fiat currencies, particularly the US dollar. Crypto barely registers on the radar. Nevertheless, Cynthia and French insisted that the DOJ investigate two of crypto's largest companies on admittedly baseless grounds. What stood out to us the most was the final sentence of the letter. Quote, "We strongly support swift action by the Department of Justice against Binance and Tether to choke off sources of funding to the bad people currently targeting a specific country." Note that I'm paraphrasing that last bit so this video doesn't get flagged by the algorithm. Now, perhaps we're reading too much into it, but investigation and swift action are two very different things. It's possible that Cynthia and French mean that the DOJ moves swiftly to investigate these two crypto titans. The thing is that Binance has already been under DOJ investigation since at least May this year. Some of you might recall a viral report which claimed that the DOJ was actually worried about pursuing an enforcement action against Binance because it could risk an FTX-style market crash. It's safe to say that this collapse would be much worse if it was Binance, and apocalyptic if it was Tether. For context, Binance still makes up more than 50% of spot trading volume in the crypto market, and almost all of crypto's trading is happening against Tether's USDT these days. So, a crackdown on Binance would be the equivalent of a nuke. A crackdown on Tether would be the equivalent of a dinosaur-era asteroid. Now, the bigger issue, though, is that two of the most pro-crypto politicians in the US are the ones pushing for this. If these truly are the most pro-crypto politicians in the US, then it suggests that all the others aren't that genuine either. Some would say this is just another case of politicians being politicians. Speaking of which, if you watched our video about crypto lobbying, you'll know that crypto has had a strong presence in Washington, D.C. This has likely been a contributing factor to the pro-crypto stance we've seen from many politicians. The recent FUD, though, has reportedly affected these lobbying efforts. What this means is that once pro-crypto politicians could be changing the colour of their scales to reflect the anti-crypto lobbyists that are propping them up. However, in this circumstance, the explanation could be as simple as the realisation that Cynthia was never really pro-crypto. She was only pro-BTC. Case in point, last December, Cynthia noted that ETH was now a security because of the merge. Believe it or not, but this seems to be the same reasoning that SEC Chairman Gary Gensler has about ETH. He famously noted that proof-of-stake cryptos are securities on the same day as the merge. This is a real possibility, and it's a sobering reminder that Bitcoin is the only thing that's viewed as legitimate by the powers that be. Everything else is either a speculative security or a scam. Now, to be honest, this isn't entirely wrong, but there's a middle ground somewhere that's being lost in bad regulation. This is worrying given that we're in the then they fight you phase of crypto adoption. It looks like anti-crypto interests are starting to get the upper hand in this historic battle for financial freedom. The irony is that the territory these anti-crypto interests stand on is starting to slip away like sand beneath their feet. This brings us to another headline that seems to have been missed by many, and that's the news that JP Morgan CEO Jamie Dimon would be selling shares in the megabank for the first time since becoming its top dog in 2006. Notably, this happened on the same day that there was an escalation in the Middle East. Coincidences aside, Jamie's not just selling a little, he's selling a lot. 1 million shares worth a whopping $140 million US. Why? For, quote, diversification purposes. Given all the insider trading we're seeing among powerful people, it's perfectly possible that he knows that something big is coming. More about that in the description. I digress. Now, the bigger reason why Jamie's stock dumping is suspect is because of what's been going on in the banking sector. To bring you up to speed, rising interest rates have caused the price of US bonds to go down. Banks are some of the largest holders of US bonds. This has left them with massive losses. Now, the catch is that these losses are unrealized, meaning that if they hold the bonds until the due date, they'll get 100 cents on the dollar. The problem is that if too many depositors ask for their money back, the banks will have to sell these bonds at a loss and may not have enough to honor withdrawals. Obviously, not having enough money to honor withdrawals means bankruptcy, and it's why a bunch of banks went down earlier this year. Now, this banking crisis seems to have been forgotten about, but it could be about to get worse. That's because US bonds have continued to crash as long-term interest rates rise. On the one hand, it's possible that a potential crisis, such as the emerging one in the Middle East, will result in a flight to safety, investors piling into US bonds, which will cause their prices to rise and long-term interest rates to go down. Based on the headlines, TradFi investors are begging for this to happen. On the other hand, however, it's possible that no significant crisis will occur and a flight to safety won't be needed. This would mean that long-term interest rates continue to rise and bond prices continue to fall. Paradoxically, nothing bad happening would be the most painful outcome for the markets. It would also be a death sentence for the banks, including the mega banks, if the unrealized losses become big enough. To be honest, it's almost impossible that JP Morgan would go down, given that it's the biggest of the big banks, but I suppose you never know because of all the derivatives debt out there. Speculating trillions with lots of leverage on dumb stuff that should probably be illegal. Whatever the case, Jamie's stock sales are being rightfully seen as a sign that something could be about to go horribly wrong. Again, paradoxically, this could be incredibly good for crypto, especially if it's something that happens in the banking system. Remember what happened during the banking crisis in March. To refresh your memory, crypto prices pumped because the Fed was effectively forced to print money by introducing a special facility that allowed banks to borrow against their US bonds as if they were trading at full value. Fed data suggests that banks are still turning to this facility for help, albeit less so. Come to think of it, it's possible that this is what BTC is sniffing out. It would certainly explain why gold has pumped so much over the last week. The only question is whether BTC will continue to act as a safe haven when the crisis comes, or if it will crash like all risk assets. We could find out sooner rather than later. And with all that said, it's time now to turn to last week's top-performing cryptos. Jessica, take it away.
Thanks, Guy. Well, last week's top-performing cryptos were Mina Protocol, Pepe, Injective Protocol, Conflux, and Gala Games. Starting with Mina Protocol, its Mina coin appears to have pumped because it was listed on South Korean crypto exchange Upbit. For context, South Koreans are crazy for crypto and have a habit of pumping newly listed coins and tokens. Now, as you can see, Mina's price appears to be squeezing to the upside on the weekly. Our only concern is that the long wick on the weekly candle suggests there's been lots of profit taking. This could lower the chances of a squeeze continuing onto this week. But I suppose you shouldn't underestimate the FOMO. Next up, we have Pepe, which appears to have pumped alongside other meme coins due to the spot Bitcoin ETF hype. Some would say that this is a bad sign, as it suggests there's still too much speculation in the crypto market. Others would say it doesn't matter. The crypto market doesn't always seem to make sense. In any case, Pepe's recent pump appears to have been rejected on the weekly Bollinger Band indicator, which, like Mina, foreshadows a potential pullback in the short to medium term. This likely depends on whether the broader crypto market FOMO will continue, which is anyone's guess. As for Injective Protocol, its INJ coin appears to have pumped due to a combination of bullish announcements, including BitGo adding support for INJ custody and Injective integrating with various Google products, including Google Cloud and BigQuery. Note that these were not partnerships. Now, as you can see, INJ's Bollinger Band squeeze on the weekly is taking it to levels that haven't been seen since the peak of the bull market. This range appears to be a significant zone of resistance for INJ. If it can break above it, then a new all-time high could be imminent. Similarly to Injective Protocol, CoinFlux CFX coin appears to have pumped to a combination of bullish announcements, including its co-founder presenting at China's Web3 Ecosystem Summit, and an integration with Layer 0 interoperability protocol. Like Pepe, however, CFX's recent pump appears to have been rejected by the weekly Bollinger Band indicator, suggesting a short-term reversal. In the absence of a bullish catalyst, the impending squeeze could result in a drop to the downside, so watch out. And finally, we have Gala Games, whose Gala token appears to have pumped due to a bunch of Halloween-related crypto gaming incentives and events. Assuming that this is the catalyst, then it's possible the pump won't last past the spookiest day of the year, the 31st of October. This is consistent with what we can see on the weekly chart for Gala, and yet another rejection at the Bollinger Band moving average on the weekly. In Gala's case, a rejection to the downside could run the risk of creating a new bear market low for the crypto. It's not the only one in this position either. But if you do want to keep up with these cryptos and when they're pumping, and also want to know where you can trade them, you can check out the Coin Bureau Telegram channel. The link will be down in the description.
And that's all for today's Coin Bureau Weekly Crypto Review.
If you enjoyed it, then you know what to do. Hit that like button, subscribe button, and bell icon too.
Don't forget to check out our deals page where we have massive discounts and airdrop bonuses of up to $40,000 on some of the best exchanges, only for the viewers of this channel.
You can find the link to that resource and many others in the description below.
Thank you so much for watching, and we'll see you all in next week's episode.